Hello, and welcome to episode 4 in our podcast miniseries, Engineering the SMB Capital Stack, sponsored by our friends at Fundbox. This is the final episode in our series, and this is where we bring it all together. What does the future hold for small business lending? How will the market continue to change and evolve as banks, fintech lenders, and horizontal and vertical software platforms all jockey for position? How is the very nature of entrepreneurship changing? And how will advances in technology, especially in LLMs and generative AI, cause it to change even further? Prashant and I could think of no one better to have this particular conversation with than Jackie Reeses. Now, you probably already know who Jackie is because she's a true OG in the fintech space. But in case you don't, here's a quick partial recap of her professional journey. She led Square Capital, which was a pioneering product in the embedded SMB capital category, and still to this day, one of the most successful small business lending products of all time. She led Square's overall small business banking efforts, culminating in the formation of Square Financial Services, a de novo industrial bank. She has served as chairman of the Economic Development Council for the San Francisco Federal Reserve and is now on the Kansas City Federal Reserve's Advisory Committee for Community Depository Institutions. In 2021, Jackie bought Lead Bank, based out of Kansas City, Missouri. And in addition to continuing to support the bank's local banking customers, she has been leading the build-out of one of the premier technology platforms in the market to support banking, lending, payments, and other financial services for embedded finance. And oh yeah, Jackie is also the co-author of Self-Made Boss, a book that crowdsources tips, hacks, and advice on how to start, run, and grow a small business. She literally wrote the book on entrepreneurship. I probably don't need to pitch you that much more on this episode, given Jackie's experience and her level of expertise in this area, but suffice it to say that Prashant, Jackie, and I had a wonderful, wide-ranging conversation on the current state and future of small business lending. It was an outstanding way to close this mini-series, so without further ado, here is episode 4 of Engineering the SMB Capital Stack. Okay, Jackie, thank you so much for joining us.
Hello, how are you?
Doing great. Delighted to have you with us. Prashant and I have been geeking out about this episode in particular and really looking forward to it because we're going to hit a whole bunch of exciting areas. And Prashant, you are going to go first in kind of digging into this topic with Jackie. Delighted to do this.
All right. Thanks, Alex. Jackie, thank you for joining us. I'm going to kick it off by asking a bit about a product that is very deeply embedded in a stack and is really a pioneer in embedded capital for small businesses, and that's Square Capital. And of course, you've led Square Capital. I think circa 2015 or so is when it sort of started ramping up. And I remember Square was doing this thing at Fundbox. You were trying to embed capital through invoice financing inside of QuickBooks around that time. What's really amazing is that a decade later, Square Capital is still a very significant leader in the market. I think has served over 15 billion, and that's with a B, dollars to small businesses. What do you think has driven the longevity and durability of Square Capital over the years and its impact on small businesses?
I think the product was a catalyst for a type of lending product that really changed the paradigm of micro lending in the United States. Banks often think of small business lending as lending at $250,000 or $500,000 or more in loan size and up. But there's 30 million businesses that largely sit underneath that in the US economy. And it's very hard to assess risk using traditional historic methods of risk. And so in 2015, we were one of the first teams to reinvent how algorithmic lending enabled micro lending to happen at small businesses. And it totally reframed like what risk is. Like, is a seasonal business risky? Not necessarily. Is a tiny company that does $75,000 in sales risky? We would have argued no, as long as it's consistent. And so it took these principles of risk and completely upended them using a totally different methodology of lending. And today, fast forwarding 10 years later, I think there are so many different dimensions of that kind of lending, whether it's taxes, accounting, point of sale software, but so many competitors in the market came in with alternative ways of using data to assess small businesses in real time. And so the second thing that was pretty revolutionary was embedding it in alternative products. And it feels almost quaint today, like, ha ha ha, there's a loan embedded in some other kind of software. But at the time, it was pretty novel to say, I'm going to go to my point of sale system and I'm going to get a loan there. And I'm not going to need to deliver 8 pounds of paperwork in order to do that. And so the evolution of that, I'd say it predated the idea of embedded finance in a way. And now, you can attack it in so many different ways. You can attack it in an industry vertical. You can attack it as horizontals. But the framing of it and the creation of it and the mindset of it, both in the product construct as well as the data science construct, totally changed the ability to do micro lending.
Were you guys surprised early on with the product and kind of how it took off? Because I think, to your point, like a lot of what Square Capital is now fits very much into a pattern, but at the time it was like the first dot in a line, right? It didn't look like a pattern at that moment. And I would imagine that even like small business owners, like they were accustomed going elsewhere when they needed capital or just figuring out a way to make do without. Do you have any early memories of like when it really started to kind of click either with customers or internally, like this is the right formula for doing it for this segment of the market?
There were two business owners that I remember meeting in San Francisco. One was this like fully tatted hairdresser who owned a amazing salon that was like multi-billion dollar, or billion, sorry, wrong letter, multi-million dollar in revenue business. This guy was killing it. And I was like, I don't understand why you're here. I am brutally honest with people, even to my own detriment, where I was like, go walk into the local bank. Like, what are you doing here? Like, we charge more than your business should be paying for this loan. And he's like, Jackie, look at me. Do you think I can walk into the bank? I was like, come on. And he was like, just look at me. I've got more piercings and tattoos. I am not a typical bank customer. And it was like an aha moment for me. And the dynamic that was aha was this guy's an amazing business. But like when we define traditional community lending, this guy's community was not a community that was heavily banked. It's not a country club and he's not playing tennis. And, he was hanging out in a community that wasn't engaged in like the Rotary Club and where lending officers of banks existed. And so that was like an aha moment of like, oh, communities are circles. And there are a lot of communities that are not served. That was a gigantic aha moment about how many of those people operated all across the United States. And then the second one was a restaurant chain. And it was a guy who was starting small restaurant businesses. And he had almost like a franchise business, but he was owning the units. And I want to say he had 20 of them. Very successful restaurateur. And he wanted to meet with me. And again, I said the same thing, like, why are you doing this? Like, go to a huge bank. You have a killer business. He was like, no. This unit by unit economics is better for the way my business works. And so it was interesting to see different dynamics of businesses and say one size does not fit all in a typical model. And there's a lot of business formations that are more fitting of this kind of lending. And so and then I did a tour across the United States. I met like an amazing cupcake woman in Cleveland. And I was like, God, this woman is so smart. Like, I'm so glad we could lend her money. And she would say, like, no one's lending me money in my little cupcake store in Cleveland. You saved me. Or a little food truck where he bought the back of the truck first and then the front of the truck. And you realize that you're enabling commerce to happen in pockets of the country that were otherwise not considered creditworthy. And so I remember those sellers in my head and think they were pretty formative in how to think about the product and like directionally which features we offered and how we rolled them out.
This episode is brought to you by Fundbox. Since 2013, Fundbox has helped more than 150,000 small businesses unlock over $6 billion in credit. Learn how they power fast, simple access to capital at fundbox.com.
It's incredible that the penetration of Square Capital in the Square customer base is pretty high. It's hard to tell from the outside, but when we look at, as an embedded capital player, our provider ourselves, what percentage of the merchants or small businesses have used the product, it seems like it's definitely in the high single digits or low double digit numbers, which is sometimes maybe 2x that of some of the other platforms that have embedded capital in them. And I wonder whether there's anything in particular that Square has done or that you did when you were building the product, or anything particular about the kinds of customers that you were serving. And maybe there's a little bit of that in what you just said, Jackie, or their relationship with the platform that sort of drove such strong adoption and penetration.
One of the things I advise fintechs when I talk to them, and we've probably had this conversation over and over, but when we're working with fintechs and they want to start a credit product, I often differentiate between your clients are going to need the product or they're going to want the product because it's convenient. And there's very different features you would offer for both dynamics because they yield different product outcomes. Like I need it are a lot of the clients that exist in a small business context for micro lending. I want it. You might be the expert on I want it because it's convenient, because it's like terms. It's, merchants in a fintech's product line where creating dynamics around using credit for terms is a benefit that saves them time. And I think they're very different feature sets that different types of fintechs offer. And it's all based on like the demographics, the size, the profile of the types of end customers the fintechs are working with. And so, sometimes fintechs will come to us and they have a mismatch between who their customers are, i.e. like their big customers, and then what they're offering on the credit side, because the economics are not going to match what the scale of those customers can get competitively. And so matching those demographics with the feature set is probably one of the biggest mistakes I see fintechs having. And like if a product isn't going to scale in credit, that's usually the problem I would go attack with people. When we work with people, like I'll often ask, like, can I meet with a PM who's working on this product? Like, I just want to understand some of the dynamics about what they're trying to do. This has nothing to do with our banking relationship, but I think I can probably be helpful in kind of reframing how they're matching product market fit to like which part of credit they're trying to solve for.
Yeah.
Because I think they could be very different feature sets. I don't know whether you feel that when you work with people.
I think, Jackie, one of the big things that we talk about at Fundbox is credit in context and the fact that one size does not fit all. In fact, we worked with Alex on this entire thesis of how different, even in the world of small business capital and embedded capital for SMBs, how different contexts, obviously the type of customer, their need for credit, but then also importantly, where in the cash flow cycle are you touching the small business customer? It's very relevant for what you put out there. Like we work with invoicing apps, and that's more on the front end, i.e. money coming in, or a payment platform, money coming in, right? We also work with folks where the touch point is money going out the door. So what are some of the product dynamics of people making spending decisions on the other side, or maintaining their cash on hand? So we're big proponents of the credit has to be appropriate and in context. And the tricky part about it, the easy part is for me to say it. The hard part is to actually build the infrastructure and the credit expertise to be able to handle those different kinds of use cases well. And
Oh, I agree. Credit is so much harder than debit. It's so much harder than payments. Like on the spectrum of complexity, like even the idea of what data do you have? Are you tied into, like, where are you on the waterfall of payments in order to get money back?
Right.
Because that dynamic is so different depending on where your product sits in the power dynamics with your customer. Because if you don't have a sticky power dynamic where they need to pay you back, you're probably going to be like the first party that they try to blow off, if at all possible. And so there are so many dynamics around that waterfall, and then what data you're owed, just given where you sit. Like, are you owed someone's paycheck? Are you owed broader visibility into the rest of payments coming into their system? And each of those elements adds additional data to give you more insight into how to lend or how much to lend to them. And if you don't have that, you're prone to make mistakes. And so it's a trickier business than people think.
so with this lending is hard metaphor, I think one of the things that we've been seeing of late is lending getting a little unbundled. So if you go back to a point in time where the lending process was all done inside of a bank, all the way from customer acquisition, distribution, the bank had the customer relationship, to the underwriting process done by the bank, to maybe the bank also providing the servicing on the loan, to perhaps keeping the loan on their balance sheet. So the entire thing was all bundled together. And now you might see a vertical SaaS platform or a small business operating system being the point of distribution. You may have someone like a Fundbox working with lead bank to originate the loan and to underwrite and all of that. And eventually the loan may be purchased by, a large asset manager. So there's some sort of unbundling, if you will, or specialization in this. What do you think of it?
Yeah, I think for fintech, it makes a lot of sense. And it's because I think each part of that value chain is good at different things. The balance sheet hold of loans should happen at a gigantic balance sheet GSIB or a fund that specializes in buying fintech loans. You're going to get, as a fintech, you're going to get the best returns and the best deal for your product. And if you're trying to minimize unit economics, you want the lowest cost of capital. And so go to people who are experts at that. When you talk about underwriting and loan origination, you want people who are great at that. And then the banking infrastructure and the part that enables the system to operate, you want someone whose infrastructure is good at that. And I think they're very different skills in that ecosystem. And unless you find someone that's non-automated and they're doing just like gigantic loans, I would rather have pieces that are good at each of those functions. I don't think that's always a priority for folks who come in. Like, I know we talk to a lot of people who say like, oh, we'll only do this if you have a big balance sheet. And I'd say like, but you're going to find two very different skills when you do that. Like,
right.
You don't want my balance sheet. My balance sheet's going to be more expensive than if you go to XYZ institution. And I'd rather you go get a better deal because I can make money off of lending you my balance sheet, but it's not going to be the best deal and best unit economics for you. And I'd rather have my clients successful. I'd rather have you successful. And the more you're successful, the more you'll grow, and I'll grow that way, than to feel like I got a bigger share of the pie doing something that I'm not truly good at. But I think the dynamics around needing to deal with balance sheets are more complicated for fintechs than people imagine. And I do think if a fintech is going to offer a credit product, building out a capital markets practice over time can be critical to building, a successful product. They don't need to start with that, but it is something that they're going to need to be good at. And it's different than the banking partnership side of things. Sometimes people combine the two of them.
Yeah, that's interesting. I mean, it seems like there's a maturity curve to each of these jobs to be done, right? Where it's like at the beginning, from maybe a capital perspective, we're like even very, very early on with lenders, non-bank lenders, you see them lend out of their own equity, right? Where it's like we just have to establish our model, we have to test out our underwriting, we have to be able to show performance. And then once we show performance, we'll go get a small warehouse line, or we'll find some way of financing our loans. We maybe won't get like the best deal in the world, but then as we scale up, we'll become more sophisticated. And eventually you become very large non-bank lender, like Square prior to getting a banking charter, or a firm or someone like that now, where it's like now we have performance, we have a whole capital markets team, we can really sort of control our own destiny here. The other thing, Jackie, that I wanted to ask you about on this unbundling question is, I mean, there's obviously like the famous quote around, you make money unbundling, you make money rebundling. Like these are the two ways that you make money in business. I am always curious to sort of think about where we are in the cycle of unbundling and rebundling, because one of the interesting pieces of data, and Prashant and I actually talked about this in an earlier episode in this series, is when the government surveys small business owners and tries to find out like how are they using credit, and are they getting as much credit as they need, and what problems are they having, who do they apply for credit for. One of the interesting dynamics that I notice a lot of times is a bit of a divergence between who small business owners choose, and this kind of goes back to your point about convenience and speed and like I need it now, versus who they say they're most satisfied getting loans from over the long term as it relates to the relationship they have, the pricing they got, the terms they got, the service they got. And it's interesting because when I think about the evolution of this unbundling, a sort of middle point of that evolution was we're going to unbundle everything and we're just going to be the financial services provider. We're just going to be the lender, right? So this was kind of the like cabbage on deck era of small business lending in some senses, when the lender had no other relationship with the small business owner. Their value proposition was really built around speed of underwriting, speed of funding. But the feedback from small business owners, I think, and it continues to show up in these surveys, is these guys are great when we need the funding, but afterwards it kind of feels like eating too many Doritos. Like I don't feel great about it afterwards, relative to working with a community bank or someone who maybe is a little slower, but I feel like I got a better, maybe more integrated experience. How do you think about the relationship between unbundling and like customer satisfaction for these small business owners?
Yeah. First, I would say if community banks are able to offer loans and build that relationship locally, like more power to them. I think there's a place across the country for community banks to thrive, including with fintech products incorporated into their offerings. And I know, like Prashant, you do that with Fundbox. You work with banks, and I think there's a benefit to doing that and to offer those products. Like that's great. We offer small business loans across Kansas City and the Midwest, and absolutely a place for that. And I'd say on the technical side, though, I frame it as so these products are happening in context, and there is a blurring of the financial transaction actually happening, such that when you transact either with payments, with credit, or otherwise, you're transacting in context of something else you're trying to do. So we started talking about, Square Capital. Square Capital happens in context of a cash register and a cash register dashboard. You have in context where you get out of an Uber, and you pay, automatically because you have a card attached, or Uber drivers through branch have payouts that happen every day. And so there's a power to that dynamic happening in context to where these transactions are happening. And I think we've evolved from events happening horizontally, albeit point of sale. We then move to verticals. Restaurants point of sale, developer point of sale, retail point of sale, service point of sale. We then happen in context. So now there are broader sets of apps where you have multiple products being offered because you're having both financial services and some other kind of purchase happening at the same time or some other kind of media or event. And I think that's the natural evolution of where fintech goes, where it largely becomes invisible to all of us that we've actually transacted. And taking away that friction, I think, is the holy grail of what we should all hope to do so that there's a relationship with consumers or businesses, and that relationship is pre-validated. And then we're able to offer products and services that are financial products that happen to be easier, quicker, with less fraud to deliver.
So, Jackie, in what you just said, there's another element of unbundling or unpackaging that's going on, which is as a small business owner, I might be working with some sort of small business operating system that's providing maybe at least at the front end in a more unified way, payments, i.e. card acceptance and payroll and capital and checking accounts and so on. But that could be done through different fintech providers. I can imagine, partner using Stripe for payment acceptance and Fundbox for capital and Gusto embedded for payroll and someone else for, say, checking accounts. And potentially these are programs with different fintech bank partnerships involved. Do you see that as a potential structural or strategic issue? Or do you see that more as just something to be figured out from a product and execution perspective? Things like, are you going to do a KYC, KYB check on the customer 4 times because there are 4 different providers? Like, how do you think about that? And especially from the perspective of, and Leadbank works with so many different fintechs across a range of financial, product, from lending to payments to accounts and so on.
I think there's a few layers in there that you see across the horizontal. Identity is one, KYC, KYB, just very specific checks you have to do there. They're 2 good examples. And then, like willingness to pay, all the dynamics around lending, if it's a lending business, all of those you could see across a horizontal. And I think the question that will evolve, probably driven out of agentic commerce, is how that horizontal gets used and who has permission to use it. Because I can't imagine fintechs want their data seeded to a broader platform unless they specifically opt in, where they're going to give and want identity data back. We have to figure that out. And so I could see independent platforms trying to create this layer around some of these features that fit across a horizontal and add benefit to everybody. But it's not clear to me yet who's willing to do it, who's not, and why. But I think it exists. Like, I know we certainly could do it. And I do think it would benefit clients in a pretty significant way in order to know certain elements of data that could yield both fraud and credit benefits to all of them. I think on the agentic commerce issue, though, we're going to have to get to a point where permissions change around how accounts are accessed, and who has control over them in an automated way. And that might change the dynamic also on a horizontal level across multiple fintechs. But I think we're still such early days on all these issues with the horizontal infrastructure layer that I don't have an answer yet on how it happens. I could just see it happening, just given the data that sits across Lead as an example, with some of the biggest fintech, e-commerce, and crypto companies in the world sitting on our platform. I mean, right now, we don't even share who our clients are. I asked you before getting on this call, and I even say that we work together in a client relationship because we don't walk around and say who our client is. We only speak through our fintechs, and it's up to them to comment that they work with Lead unless it shows up in disclosures, we won't mention client names. I can't imagine going to a bank and expecting them to be like, oh, guess what? Guess who I bank? I would be so offended. And so, we don't have testimonials. We don't comment on who we work with unless someone is more proactive in saying it.
Just for the record, there's a testimonial on this conversation on Fundbox working with Lead, and just how great it's been partnering with Lead Bank and on some of the things that Jackie talked about.
It's not for me to say it.
See, she led you right there, and then you gave the testimonial on the podcast. No, it is interesting though, because Jackie, one of the things you were saying before about these small businesses that are kind of under that traditional bank threshold, part of that is the bank's like workflow and process and how inefficient it is for them to originate commercial loans below a certain size. But the other part of it is a lack of shared infrastructure underpinning a lot of this, right? Like there is no real good comprehensive equivalent to a consumer credit bureau for true small businesses, right? Like that type of data doesn't exist. And to the other point you made, small businesses are also different from each other, right? Like a seasonal restaurant is going to have a completely different credit profile and performance profile than an HVAC installer, right? Like they don't look the same, and what good and bad looks like differ quite a bit between verticals. But I do wonder if eventually we do see, because we have all of these individual platforms doing these amazing things, if we do eventually see the development of more shared infrastructure, because you can imagine that like one of the benefits to small businesses is the ability to have a lot of offerings at their fingertips, right? And Prashant, this is something you and I talk about as well. Like sometimes the loan that you can get through Square Capital isn't the best fit for you in that moment for whatever reason. And the ability to then go over to a different platform or different provider and get a loan that's a better fit, like there is a benefit to that. And so I wonder if eventually we do see the development of more kind of shared infrastructure across all of these great ecosystems that are serving their customers well, but are kind of closed by default.
Well, even, Square's not alone. There's Stripe, Shopify, Toast, Intuit. Like people have built out all these products. I'd say also you look now at the development of infrastructure. Like when we went to start a bank at Square, it was 10 years ago. And you think back to 10 years ago, the infrastructure needed was so different then versus it is today. Mm-hmm. And now you have the evolution of infrastructure providers. Like we're the underlying bank infrastructure. It didn't exist 10 years ago in the same way. I would trust us now, not take the regulatory burden. I'd feel so much better. That is really different than historically. I'd say the same thing like around those that could do underwriting and those that could do lending as a service, like the world that you sit in, like that's infrastructure that banks can use that they historically didn't have access to. And so I think that's where the market's just changed, and you can level the playing field for a bank to offer both algorithmic lending and local lending. I think both can happen very simply today. And it's a more generalized point around how the infrastructure side of fintech has evolved to be so much stronger recently that these kinds of services can be offered beyond, the 60-mile radius of San Francisco and New York. They're more for businesses across the United States.
Yeah. And it's a bit of a cliche to say this, but it's kind of true that about a decade ago, the conversation was a lot about banks versus fintechs. And I think we've all grown up and moved on to a more productive conversation around how banks and fintechs can work together in a variety of ways. And with perhaps financial technology companies building out a lot more infrastructure that can be used across a variety of partners.
Yeah, it's just, it's a very different market today. I'd say the same thing for crypto. There was a very challenging dynamic with crypto pre-Silvergate and Signature. And after that, it was a very different dynamic where the industry realized that connecting into the banking system widened their distribution net. And without that, it limited on-ramps and off-ramps. And so it really ratcheted back a lot of the challenging dynamics, or at the time, it was almost an unwillingness to adhere to some of the U.S. banking laws. And so that's somewhat of a non-starter for someone who controls a bank charter. You need your clients in a business like this to be very willing to follow the regulations. Like, we're an anti-network effects business.
I've heard you say that before. Yeah.
You take in a bad egg and it's not good. You need to work with a bank that has good judgment about who their customers should be, because we've seen it before. There are banks that have had to offboard customers because they didn't know how to manage the regulatory. And so you need to know who you're partnering with and how good they are at some of these elements of client choice. And so, I do think there's a dynamic there of relationships where somewhere in the ecosystem, you're both a competitor and a client all at the same time.
Yeah.
We see that all the time with partners.
Yeah.
QuickBooks is a great example. We just celebrated our 10th anniversary of our partnership with Intuit, and we help drive capital on the QuickBooks platform. But in some sense, we also compete because they have their own offering. Again, it's a little bit of different credit box and so on. But I think almost all of a large number of our platform partners have some sort of capital offering of their own, and yet they're using us to augment and to grow. And I think that's just part of the ethos that we live in today. Now, you talked a bit about regulation and crypto, and one of the things that we sometimes think about is that in today's world, where a lot of the dialogue is full of sort of crypto and stablecoin, when you go back to good old small businesses and small business capital, where do you see this on the radar of regulators as something of importance or something to look at? Like, what kind of dialogue do you come across as you talk to regulators when it comes to lending and small businesses?
Yeah, I was at a Fed event last week with community banks focused on innovation, and this idea of what's the use case for both the community bank and then the small business as the extension of that community bank. What's the use case that somebody should think of stablecoins for? And I'd say there are two dynamics. One is that there could be an infrastructure advantage using stablecoins if there's significant cross-border relationships where you have cross-border settlement. So I'd start there with a use case that you can make an economic decision about the cost per unit. And I think that is becoming more and more accepted as a use case that will probably be first in line for more traditional Main Street companies. And so you'll see examples of payment cards or cross-border settlement that you don't even know that it's necessarily using settlement, stablecoin settlement. It's just faster, better, cheaper. That's one point. Not in all cases, but in some cases. The second point is one over time. I think banks are going to want to offer crypto and digital assets as part of a wallet choice. And so you won't have to make a fiat versus everything else decision. You could hold whatever assets you have in whatever denomination they're in. And I think that idea of wallets that can hold more than just fiat dollars will become more prevalent into the banking system. And it'll hit small business in a place where they might have a lot of foreign clients. They want to pay in a particular cryptocurrency for one reason or another. And they're either going to want to hold that crypto or they're going to want to convert it into a stablecoin or a dollar. And all of those options should be available because financial institutions shouldn't be limited in what they can and can't offer in terms of currency choices. And today, banks, for example, can issue and deal with dollars or euros or other foreign currencies, but yet they're somewhat limited in dealing with digital assets. And so that will change probably in the next 2-3 years.
So that's really interesting because the other kind of backdrop to it from a small business perspective is just that a small business today is kind of naturally more global than small businesses were, a decade ago, certainly 50 years ago. So even like whether it's sourcing components from other businesses across multiple countries, or it's having customers or counterparties that you work with, like that idea that stablecoins can be a piece of the infrastructure, even for very small businesses, makes a lot of sense. The other thing I wanted to ask you about, Jackie, on the regulatory front before we let you go is you mentioned agentic AI and agentic commerce before. Where do you see regulators on all the AI questions? Because I think that like small businesses are a good example of a sort of potential customer base that on the one hand could enormously benefit from AI, right? I mean, we talk all the time about, small business owners have no time. They're just drowning in like back office tasks that are kind of routine, but are difficult to automate using traditional software. And, the pizzeria owner just wants to get back to making pizzas and stop doing these things in the back office. So it seemed like AI would be really powerful as a tool for these folks. At the same time, I would imagine regulators' concerns about fairness and the explainability of how this technology works and how it's implemented between probabilistic systems and deterministic systems, like as you talked about, regulators care about protecting small business owners as well and making sure that they get a fair shake. How are they thinking about AI?
So I don't think they have an understanding yet today. And I think they would love to deepen their knowledge, but they're not there yet. And I think part of that is largely because the products don't truly exist today. And that's beyond ideas like, oh, Stripe payments on OpenAI. Like that to me is not true agentic commerce. It's
Right.
Stripe doing what Stripe does well.
Yeah, right.
But there's things like consumer consent, error resolution, liability for unauthorized transactions, disclosure obligations, like things like that are issues that we need to develop policies for because it doesn't exist today. And so those are the types of areas that really need to be hashed out and sorted in order to decide even simple questions of like who's responsible if a transaction happens without the consent, and where does liability go, and how do you get money back in a fraudulent situation. And so, or even returns. Returns are complicated even in-store commerce, let alone e-commerce. Now agentic commerce just fuels the complexity of how that whole thing happens. And so, we're just getting started in sorting out these issues, and we're starting to think through some of them, but they're ideas that are going to require a lot of work to understand because the velocity of money is so much quicker in 2025 than it ever was. And you see that with real-time payments. Mistakes are harder to reverse. And you have to understand who's responsible for those mistakes in order to feel like you're in a safe world. My hope is that we don't get caught in a counterparty problem, either in crypto with a lot of the foreign companies that exist, or counterparty in agentic commerce, because those are the two risk areas that feel less tread upon in the current environment where, you have a mass consumer problem and you have to go to El Salvador to try to federate how to solve the problem. That's not a world we've figured out yet as an American consumer. And even though the Genius Act started to define liability, there's still a lot of regulation on both the crypto side and then agentic commerce, which is yet to come in order to start to tackle a lot of these issues.
So, Jackie, in our conversation, perhaps the most important constituent is the small business owner. And we may not have a lot of small business owners tuning into this podcast, but we do have and do expect to have a number of folks who are trying to build products for small businesses, fintech products, technology products. And you've spent a lot of time talking to small business owners. In fact, you and Lauren Weinberg wrote a book about advice from small businesses. What thoughts might you have for people who are looking at the space today, builders, and thinking about where are there opportunities to serve the small business community through technology?
I think it's a great place to serve because the sophistication from a technical point of view is very limited. And so where technology can automate workflows that were manual and save time for small business owners, that is a driver of buying behavior. And so if you think about a small business owner, most of them don't have employees. And therefore, there's no CFO behind the scenes, there's no CTO. And so, where you're able to automate, and usually in systems that fintechs and tech build, that's kind of part of the value prop is some combination of automating complexity and putting a visual experience around it that makes it simple to use and intuitive. And so I think it's a really right market for builders to find use cases that are incredibly valuable to small business owners. So anytime you could do that, I think there's an incredible amount of value. I don't think builders can underestimate the terror, though, of not having customer support and not having some ability to kind of make a phone call in a crisis. I think that's a hard challenge for people from a cost structure point of view to figure out, like, what's the right model to use so that somebody can actually get a human on the phone that can be helpful. And so there's some ideas around, after you manage the front end and the workflow and the complexity, then what's your operating model around how much of it's fully automated versus a human component underneath the hood to be supportive. Because again, as I said, they don't have employees to go through this. And so those are the dynamics I think are helpful for those building for small business. It's a very smart audience. Like when I traveled around the country to meet with small business owners, or I talked to folks in the middle of COVID on PPP, I was struck by the passion and the raw intelligence about who they were serving and why they were serving them. And also struck by how much they have to jerry-rig systems in order to try to make their lives easier. And so I would advocate for people trying to build for this market and realizing that it's deeply underserved. And so I know I certainly enjoyed it. You're in the same space. I'm sure you feel the same way. I don't want to put words in your mouth.
No, but couldn't agree more. It's definitely something very fulfilling to have served a number of small business owners, and every time someone writes in and says how happy they are to have found us, it's great. As an embedded platform, sometimes I got to tell you, Jackie, they complement the platform that we fit into, as opposed to Fundbox. So it's like, hey, Joyce lending is incredible, or whatever, and that's great. That's great. That. We want our partners to succeed, and we are happy to be a little behind the scenes. The bass player who never gets the spotlight but just keeps the groove. We're fine with that model, but it's very, very fulfilling.
Yeah, it's great. I when I wrote that book, Self-Made Boss, with Lauren, we talked to a lot of small business owners. We interviewed them. We had the best stories of like an oyster supplier in Long Island and a house manager in Aspen, Colorado, and just like really cool people. It was an absolute joy to write, and I met a lot of cool people. I actually, if people appreciate their neighborhood, this is going to sound so motherhood and apple pie, but if people appreciate their neighborhood, I think they have to be willing to pay a little bit more in order to keep their neighborhood thriving.
Yeah.
And like, I want a toy store in my town, or, like I want to be able to buy toys, and I want to be able to go buy, cookware, and I want my grocery store to to be in my town, and I want my restaurants to exist. And I think there's a mental price we all have to pay to commit to wanting our town to be great.
Mm-hmm.
And I'm willing to pay that, off the back of, huge companies that, are trying to eke out basis points, and, it's a little less local. And so I like the local community feel.
That I think is an awesome place to leave it. That's the perfect note to end this podcast episode on, and in fact, to end this podcast series on. Jackie, thank you so much for ending on a good, optimistic note. This was an awesome conversation, and Prashant and I really appreciate you joining us.
Oh, my pleasure. Good to see you both.
Thank you, Jackie.
Running a business means juggling a million different things, but getting credit shouldn't be one of them. Fundbox makes it easy by plugging directly into the platforms that small businesses already live in. That's why more than 150,000 businesses have tapped into $6 billion in capital through Fundbox. They're basically the capital layer of the digital small business economy. See how at fundbox.com.